All right, Ken Orange Theory Trader, back with you with another video talking about dynamic risk management. It's a deep study, so let's get into it. Now, what is dynamic risk management? It's the process of adjusting your trade size and risk exposure in real time as you're in a trade. So it's going to depend on the market conditions. Instead of using a fixed dollar amount, it's a little more nuanced and, dare I say, even complicated, but it doesn't have to be. I'm going to break it down, make it real simple for you. Okay, but every trade is going to be different is the point. Now, the benefits of using dynamic risk management are as follows. Number one, it helps you preserve capital. Say, for instance, if you always risk, let's say 5% of your account, 5% to make 10%, I don't know, 1 to 2 risk to reward ratio. What you're doing is you're guaranteeing that you're going to lose 5% instead of possibly stopping yourself out early should something happen in the market that takes you by surprise. That's one thing. So it can help you minimize your downside. Number two, it does help with faster compounding because it capitalized on high probability opportunities. Okay, those trades they just work out and they work out great. And lastly, it does help with your adaptability because it notices or acknowledges that the market is not static. It doesn't go up in a straight line, down in a straight line. So your risk should not go up in a straight line or down in a straight line either. It should be as dynamic as the market can be. So in Forex, okay, the market's personality can always change. All right. So the analogy I like to use is that using dynamic risk management is like a person who accelerates when the road is clear, and then they may slow down a little bit when the conditions aren't as good. Like say if you're driving through a snowstorm or driving through a patch of ice, like it says here. But a person who uses fixed risk reward ratio, that's like a person who's just said, you know what, I'm going to do 50 miles an hour on this road, regardless if I'm in a school zone or highway, driving up a mountain or down a mountain. I'm just always going to do 50 miles an hour. Does that make sense? Not really, okay? Because we realize, like I said, the market does not travel in straight lines. We wish it did, but it does not. So when we're dynamic, we're always considering the conditions of the market to let us know when we should push the gas or when we might want to, tap on the brake every now and then, okay? So this is what separates professional traders from retail hobbyists. So let's take a look at a couple of examples here. If trader A has a $100 account, he uses 1 to 2 risk to reward ratio and a 40% win rate, and he risks 5% per trade. Trader B starts with $100. He has 1-to-1 dynamic risk. So 1-to-1 is just where he starts. That's not where he stays. And he has a 70% win rate, and he risks 8%. Now you might be wondering, well, why does the 1-to-1 guy have a higher risk to reward ratio? You have to remember that if your profit targets are lower, on average, as long as you're trading with an edge, typically the lower your risk and reward, the higher your win rate. So that's why some people don't like 1-to-1s because they see it pointless as, okay, well, if I risk $10 to make $10, what's the point? I'd rather risk $10 to make $20, right? And while you can do that, you do sacrifice the amount of wins that you can get. But the odds of you making 10 versus making 20 are greater because your take profit is closer to your entry as long as you enter with an edge. Okay, so that's the rationale behind that. So I just did a quick chart here, and as you can see, trader A, who uses the fixed risk reward here in blue, let's go back, tends to just teeter around his balance. He's constantly paying ping pong. So even though he did, did end up with a profit, the professional trader who manages his risk effectively, adds to winning trades, cut losers quickly, okay, does manage to compound his account more efficiently. That doesn't mean he doesn't take losses because as you can see, he's up, then he's down, he's up, he's down, he's up, but it's just like a regular chart with higher highs, or lower highs rather. Got a low here, got a little bit of a low here, another low here, but his equity curve is constantly going up. This right here is more sideways action because you remember you're just doing 1-to-2 and it's just fixed. So you can still compound your account using fixed, but if you want exponential growth on a quicker scale, use dynamic risk reward ratios, okay, or dynamic risk management. Now, it's an important thing to realize though that you can do just fine with a fixed risk reward system, okay, because dynamic risk, it does require your time and attention. If you do not have the time, and especially if you do not have the discipline to manage a trade and actually be on the chart, like if you have a job and you're trying to trade between, doing your task at your job, this isn't really for you. I'm sorry. It's best in your case to stick with a fixed risk reward ratio, okay? Because like I said, this takes time and focus and discipline. But the goal in trading is just to make money. It doesn't really matter how you do it. It just matters that you win more than you lose. As long as you do that, it doesn't matter if you use dynamic methods or if it's a fixed static method. That part doesn't matter. So a few essential tips for dynamic risk management before I show you some real chart examples. The most important rule is that you stick to your max loss. That's non-negotiable for static or dynamic. Okay. So be it you risking 1%, 5%, 20%, it doesn't matter. You must stick to that risk. So for example, if you enter a trade with a max loss of let's say 20 bucks and the trade goes into your favor and you add a second entry, you must adjust your stop loss so that both trades, should they lose, still equal $20. And I'll show you an example of this on the chart. But you should never exceed your max loss. Okay? Ever. So if you're risking 20 bucks, your trade goes into profit and you throw another position on, that doesn't mean you increase your risk to 40 bucks. Okay? Don't double it. Keep it the same to protect your downside because you can always lose. Tip number 2 is you can use a volatility filter like the average true range. So if the average true range is high, you can decrease your position size. If the ATR is low, you can use a normal size. And it does help you figure out your stop loss and keep it in the context of the market as it's happening. Okay, and I'll show you this as well on the charts. As well, another good method for dynamic risking is free trade, whereby if your trade goes 50% of the way to your target, so again, just stick with that example, you're risking 20 bucks. If it goes into profit 10 bucks, move your stop loss to break even. That way it's a risk-free trade. Okay, you can just relax now, and either you're going to lose nothing or you make 20 bucks. Okay, so that's another entry, another method as well of using dynamic risk to reward ratios or dynamic risk management. And the last and one of the most important tips as well, make the market earn extra entries or scaling in. Never add to a losing trade, or also known as averaging down. Okay, that is very dangerous. Only add to the winning trades. Okay, so the rule is that you only add a second position when the first one is in profit. Now, some people may wonder, well, how much in profit does it have to be? That's really up to your discretion, to be honest with you. So it's really up to you. But the reason is that when you average into winners, you can turn a small win into a home run without increasing your initial risk. That's how you grow a small account very exponentially and quickly, by adding to your winners, not by adding to your losers. So now we're going to take a look at some live examples and put it all together. So I'm going to show you now on the chart, and I trade the 8-hour chart and I trade the candle range theory. So all I do is trade candle 3 patterns, but this isn't so much about trading as much as it is how to structure the risk. But we have here a candle 3 pattern right here. Right there. So I'm going to go to the replay option now. And let's take a look at how we could possibly structure our risk. Now, this is based on my entry criteria. Obviously, if you don't trade the candle range theory, you have to fit it to whatever trading method that you use. Now, first off, I base my entries primarily on fair value gaps. So candle 3, fair value gaps. That's pretty much all I need to see. So let's see, candle 3 does open here. This is 1700 or 5 o'clock p.m. Eastern Standard Time. So the best entry, let's just say we start like right in here. We're in this general zone right here. And you know what, before we do that, let's check the ATR. And when it talked about the ATR, it talked about looking at the average true range of the candles as they appear on the chart. So 2 indicators that can help you with this is just if you go to your indicators on TradingView, if you type in ATR, which is average true range, that will give you this number right here. It'll show, this right here. See the red number? I know it's kind of small, but hopefully you can see that. Those are the average sizes of the candle for the last 13 candles. That's the average size of them. And then another one could be the candle size, height of candle body. That will tell you, and that's this one right here, how big each candle is. So then as you look at them, and you only need to check it really like once. Once you know what the ATR is, typically you don't really need it after that, once you know what it is. So when I take this entry right here, right, we see at the time that the average true range on the chart for these candles, they're moving an average of every 5 minutes, price is moving about 11 pips based on what that says there, okay? So with my stop loss being at 20, that gives me enough cushion to say, you know what, I think is good. Now, if the ATR is a little higher, maybe you want to do a 30 pip stop loss, 30 pip take profit. I mean, it's up to you. But the deal is with being dynamic, you're basing it on what's actually happening in the market. So again, because the ATR is about 11 here currently, I mean, if you just want to say like double it. So if the ATR is 11 pips in 5 minutes, then okay, I'm going to double that, and that'll be my stop loss. And then it'll also be your take profit. So it's just done for you. So that's how we do that. So that'll be the first entry right here. So now let's get into the dynamic portion of it. So we don't really need that anymore. We can get rid of this. And that, okay, we don't really need that anymore. Okay. So now as price goes on, so we based our first entry off of this first fair value gap, and it goes into profit. Now, in terms of the second entry, one tip you can use for your second entry is you can enter a second position when whatever candle you enter on gets closed above. So in this case, because this was our entry candle right here, and you notice we did have some drawdown, right here at 7:15, price closed above our entry right here. So it would have been in profit. So you can add your second position right here. But here's the dynamic part. Okay, this is how you can structure the risk. Now that I have my second entry, remember that both stop losses have to equal, what do we say? 20 pips. So all we do is we adjust this to 10 and adjust this to 10, just like that. Okay, so let's type that out real quick just so we can keep track of what we're doing. So we know that our max risk is 20 pips, or let's just say, to keep it, let's just say $1 per pip, 20 bucks. All right. But now what we've done is, now that we have two entries, one entry is worth 10 if we lose, and the other one is worth 10 if we lose, right? Okay, that's worst case scenario. So our max risk did not go down. It's still at $20, even though we have two entries. But now let's take a look at our gain. The first one could be worth 20 bucks. And the second one could be worth, if we keep the take profit the same, or not the same, but relatively the same here, about 18 plus 18. Okay, and obviously that will give you 39 bucks, right? So what you've done is you've doubled, you're risking 20 bucks to try to get 40. And that's actually 1 to 2. But the thing is, you started with a 1 to 1 risk to reward ratio. And then when you add a second one, like I said, it doesn't take away from the fact that you're still only risking max risk 20 bucks. But now your account grows faster because instead of staying with a static program, you're just capping your downside and exploding your upside. Okay, so you went from a possible max win of 20 bucks to a max win of 39 bucks. Okay, I'm sorry, 38 bucks. Okay, 18 plus it was 20 plus 18, right, which gives you a total of 38, right, on two entries. Okay, that's how exponential growth happens, like that. Okay, that's how you have to structure it. So to make it as plain as possible, whenever you do another entry, you have to adjust the stop losses, and I recommend you keep the take profit the same. Right, so I say about 2, maybe 3 entries at the most, for candle threes at least, because price can move pretty fast. And that's how you'll see exponential growth. That's how you manage risk dynamically. You just adjust your stop losses as you enter more trades and keep the max risk the same. Do not do this where you do 1 to 20 here and 1 to 20 here, because now your max risk, if this price goes against you, it's a $20 loss there and a $20 loss there. That would be a $40 loss. That exceeds your max risk. That's what you don't do. So that's where you have to have time to adjust things if you're in front of the chart and can do that to make it make sense. Okay, but that's how you have to do it. Okay, add and adjust, add and adjust. All right, so that's one example. So let's go to one more. We're going to do 3 more. So I'm going to exit the replay, go back to the 8-hour chart. That is what I trade primarily. Okay. So we have a candle 3 right here at, what was this, 9 a.m. So we'll drop down to the 5-minute. And let's do the same thing one more time here. All right, so let's look at our ATR to see what a good possible stop loss and take profit will be. So once we get to 9 a.m., let me just isolate that time frame. So this is the 9 a.m. open right here. Okay, where that line is. And let's get our gaps up. Okay, so at the time when price starts to open, when it opens at 9 o'clock, the ATR is about 10 pips. We'll just round it up to 10. So I'll say, okay, I'll do a 20 pip stop loss. Okay, just double it. All right, so I don't really need that anymore. Okay, so I get rid of that. And then we go forward. So you could enter off of this fair value gap. Let's just say right here at 940. That looks good. We go ahead and take that. at 940 because it tapped the gap. All right. So again, we were doing 20 pip stop loss. And then if we notice, the next candle at 945 closes above where we entered. So we could have did another entry right here. But then remember what we do. Okay. Second position, we move this up to 10. And this also is 10. Right there. And then you would have been out in the next 5 minutes. Right? Because price just shot straight up. Now, let me give you another caveat here. Sometimes what you can do is you can leave the stop loss, leave the take profit open and just manipulate the stop losses. So what if we had done that on this one? Let's take a look. So let's just say we have a max risk of 20 bucks, right? We're at our 2 entries, okay? But we leave the stop loss open. Leave the take profit open. Because we don't know what might happen. Maybe we're sensing a strong market or whatever, just whatever. You got a feeling that things could really go either way, all right? So you just leave it open. If you let it go and you would have waited another, let's say, till 10 o'clock, this turns into a, 10 o'clock close right about here. And right about there. Okay. You risked 20, but you made on the first entry, and I just keep it at $1 pip to keep it simple. This right here would have been worth about, we'll say, 58 pips. And this one right here would have been where the second entry would have been about 54. So that's entry 1. That's entry 2. Right? Okay, so that's a total 58 plus 54 puts you at 112. Just waiting a little bit. Now, is this always going to happen? No. Okay, let me be blunt with you. No, that's not always going to happen. But I'm saying that's an option for you. Okay, but remember, the market can't be predicted. You can only respond to what you're seeing. But could this happen as well? Yes, it could. Right? Because all you're doing is just, remember, you're adjusting the stop loss in this case, but let's just say you would have left the take profit open. In 5 minutes, this candle shot up. And when it comes to the ATR, let me go back here. Let's see. Gaps. And there we go. Okay, when this candle shot up, that gave you the majority of your profit. This candle was 34 pips. It moved 34 pips in 5 minutes. But on average, price was moving 11 pips in 5 minutes. So this moved triple the average, right? Which is definitely an anomaly. So that's just something else to keep in mind. Okay, can that happen though? Yeah. You never know. I don't know if this was news driven or what, but that's another option for you. Again, all of this is dynamic. But the thing is that there's no one set way to manage risk dynamically. This is just how I do it. There are times where I don't set a take profit, but I'm always setting a stop loss though, because the only thing you can control is your losses, not your wins. Okay, so let's get rid of this and let's do one more or a couple more. We're going to go back out to the 8-hour chart. But again, 1-to-1 is always bad. That 1-to-1 is where you should always start. Okay, so we got pound Aussie. You know what was that? A long? We just did a long, so I'll tell you what. Let me see if CAD. I think CAD yen was a short. Yeah, let's do a short this time. Okay, so we select a bar. We'll go right here. This was at 1 a.m. Okay, so let's take a look, see what we got. We'll drop down to the 5-minute. Okay, for the sake of our stop loss, what is the ATR? Let me go here. Get my gaps up. Candle body heights, ATR. Okay, so when price opened at 1 a.m., right here, price was moving an average of only about 3 pips, right? So if you want to try a 10 pip stop loss or 15 pip stop loss, you can do that. Okay, you could. Now I wouldn't. That's a little too tight. I think 15 would be like my max if it's that tiny, because you never know, and you'd hate to be, wicked out. But let's just say, for instance, okay, so we'll just say 15. So I already got one right there, 15, 15. So that's where I start right here off of this first fair value gap at about, oh, and move over to 1 o'clock, about 120. Okay, right there. Okay, so that's where it starts. Okay, so now I can get rid of ATR. I can remember the ATR was still only about 3, so it's very small. And CAD yen, the yen pair is typically very volatile, so I would expect that to eventually go up. But what about our second entry? So if this was our entry candle, let's say this is our entry candle right here. I made this nice and big so you can see. Okay, so this red candle right here, right there. So what I need for price to do is close below this candle's either open price, or sometimes you can do it when it closes below its wick, just something like solid. So here's what we can do. Let's just say we take it, our second entry right here on this big red close. Bam. Second entry, 15, 15. Wow. Because the stop loss was so small, it would just depend on what you want to do. Because what you could do, you can still cut it in half if you want, but 15 doesn't go divided by 2 very clearly. It's like what, 7? So let's just say if you try to do like 10 there, and maybe, let me see, we had 15. That would only leave about, let's see, 5 more. Maybe about 8 there or so, something like that. And see, what would have happened here is that you would have been stopped out, to be honest with you. If you would have adjusted it straight up and put, like, say, let's just say 8. 8 there and an 8 pip stop loss here. Like right there or so. See, this might have stopped you out. Okay, but guess what happens when you get stopped out? You can just get back in, right? So, yeah, this is a good example because you're not going to win every trade anyway, so that's fine. Let's just say that happens. Now, with the way I trade, as long as the fair value gap holds, then that's okay. So yeah, this is good. This is the last example because I'm giving you a realistic picture of how it can look. So let's just say on our first trade, we risked $15 or 15 pips, however you want to put it. Okay. And then it was a loser. Okay. We averaged in, and then price came back in the next 5 minutes and took us out. Okay. Or at a bare minimum, it would have taken out this position. But let's just say you just close everything. So this trade was a loser. You only lost $15. I would hope your account's bigger than $15 so you can take another entry. So we get rid of that one, we get rid of that one. Now, but let's just say you still believe this is a candle 3. So you re-enter, let's just say right here in the zone. Now, the average is still 10 pips, or I'm sorry, 3 pips. So you're still going to stick with the 15 pip stop loss. Sorry, that's a long. Let me change it to a short. There we go. And because of that retrace, let's just say you want to leave it open. Okay. Now, so we enter on this green candle right here. You would have had a little bit of drawdown here, and then eventually price closed here and then closed here. So let's just say your second entry would have been right there on this red candle. 15, 15, right? So now we keep the stop loss as close to 15 as we can. Even if the numbers aren't divisible, just do the best you can. So let's just say you do 8 here, or let's say 8 and 8. There we go, like that. So you went from 15 to 16. It's an inexact science. But if you notice, you didn't get stopped out. Okay? And if you just wanted, now if you would have left them at, if you would have kept the take profits equal, you still would have made, let's just say on this one, that's almost a 1 to 2. And on this one, a 1 to 1.3. Okay? Or just for pip wise, you would have got 15 pips here and about 10 pips here. Okay? That's one way. If you would have left it open, you could have made, let's just say you take the meat of the move there. This would have been worth 44 pips and 40 pips, right? If you just got out on this big spike here that came at 705. Let's just say if you just leave the take profit open. Let's just say, hey, I want to see what happens. Because you can do that if you're trading a candle 3 because you expect candle 3 to give you strong momentum. That's the main characteristic of a candle 3. See, candle 3s look like this. Let me go back out. Okay, not to make it too much about trading, but when you're managing risk and you know what you expect to see, by the time the candle closes, it should have a strong move to the downside before it closes because it's a candle range theory that's completing the range. This is candle 3. So there are times where maybe you want to just leave it open. But here's the one thing you don't want to do is you don't want to leave it open and then have price come all the way back to your entry. Don't do that. Okay, so remember we talked about if it gets halfway to your take profit, set it to break even. So then what you could do also, let's just say it hits 15 pips very quickly, like that. Okay, let's just say it hits it. What you can do, but you don't want to get out of the trade, just set your stop losses to break even. And then you got a risk-free trade. And then just let it run. Right? That way, so should it retrace, which it can do, okay, you just leave it open. Just see, you know what? If the candle opens at 1 a.m., which was right here. Let me bring up my 1 a.m. template. There we go. Okay, if the candle opens at 1 a.m. and doesn't close until 9 a.m., let me wait a few hours. And you could have got out at around 7 or so a.m. because the big drop came right here at 7. And all that could have been yours. Just leaving it open, take profit. So again, that's an option. But again, the foundation to me is to start on a 1-to-1 and then just manage your risk dynamically. Okay, so you don't have to settle for 1-to-1 if you don't want to, but at the same time, your stop loss is the main thing that I want to stress here. That's what you should be adjusting first before you think about, well, let me try to go for 100 pips. No, always adjust stop loss first and then go from there. All right, so that's what I recommend. But you're not going to get moves like this every single day, so I don't want you thinking that, oh, okay, well, all I got to do is not set a take profit and I'll be a millionaire next week. No, I'm not saying that. Okay, if you can't get 1-to-1, good luck on getting 1-to-5. Okay, so, but again, know what you're doing. Okay, have a plan. That's the goal with all this. All right, so in conclusion, fixed risk to reward is just fine if you don't have the time to actively manage your trade. Okay, because it's not that you have to sit in front of the chart all day, but remember this entry was at 345, and then this exit was until about 7 something. All right, that's a few hours. Now I'm not saying you have to sit in front of the chart the whole time. You can set price alerts, but it takes time to know. Okay, I have to do this and do that. Some people don't have that type of time, so just do a fixed 1-to-1 or 1-to-3 or whatever. Whatever floats your boat. Do what works for you. Okay, but at the end of the day, I'm stressing that risk management is still rule number 1, regardless of which approach you take, be it static or be it dynamic. Now, dynamic risk reward can lead to faster growth as long as you can control your downside and you add to those winners. But starting with 1-to-1, your odds of success will increase exponentially if you do that. All right, I promise it will. But if you start with like a 1-to-5, you're asking for trouble, because let's remember. Let's say let's say you trick an entry like, say, right here, thinking that price is going to keep right on dropping. And you try to go for like a 1-to-3 on this candle's close. Okay? Because you think the momentum is so strong that it's just going to just keep dropping. But what did it do instead? By the time the candle closed, it just about came back to your entry. Right? These are the traders here who are trying to go for 1-to-3. But guess what? If you'd have went for a 1-to-1, you would have been out in 5 minutes. Okay, so there's a difference. Okay, 1-to-3. Sorry, 1-to-1, winner. So choose wisely. Choose wisely. Okay. But I hope that helps. Again, I hope I didn't confuse anyone. It's just that the risk is dynamic, which means it's changing. You have to just be in tune with the market, set your stop losses, watch it, know what you're doing, and try to maximize those winners when you are right. And when you see something going against you, when you're wrong, just cut it, get out of it. Okay, live to trade another day. That should always be your focus. So I appreciate your time and attention. Thank you so much for watching. If you have any questions, leave them in the comments, and have a great rest of your day. Take care.